Okay, so as I mentioned previously, exemptions were eliminated in 2018. So also I apologize for the length of the last lecture. I typically try to keep them in the 7 to 8 minute range. So so now you have your preliminary tax liability. So you use either the tax rate schedule or tax table. The tax rate schedule will literally, you can, the IRS publishes these books, and you can literally go in and flip to a page, and it'll tell you what your tax liability is if you're based on your income. The tax software does this for you as well. So taxable amount income is the amount remaining after subtracting your adjustments, deductions, exemptions from your gross income. This is an example of a tax table. So if it just goes along with different incomes. So if your taxable income was between $25,000 and $25,000 and $50, then you would, in your single, you would owe $3,300. If you're married, you would owe $2,846. We saw the tax rate schedules earlier. That was we'll use the tax rate schedules to solve problems on the exams, and I will work out examples of those on WebEx. So subtract tax credits. So any tax credits that you qualify. So tax credit is a dollar for dollar decrease in your tax liability. Tax credit is much more valuable than a tax deduction. So some credits are refundable. Like I believe the earned income tax credit is even if you don't have any taxable income, if you qualify for it, you still get the money. Health insurance premium tax credit is American Opportunity Tax Credit, Lifetime Learning Tax Credit. These are education related. The two that I mentioned, Lifetime Learning, I believe, is the one that you can only use once. Earned Income Tax Credit, that's the one that I believe is you can get to apply the credit even if you have no taxable income. Child Independent Care Tax Credit, Child Tax Credit. Let's see what else. Adoption Credit, Mortgage Interest Credit, Retirement Savings Contribution Credit. These are mortgage interest credit and retirement savings contribution credit generally apply to low-income individuals. And the elderly or disabled tax credit. So your final tax liability. So after you subtract out your credits from your preliminary tax liability, you arrive at your final tax liability. So you add up all your prior payments from your withholding and any estimated tax payments, and calculate the balance due or amount of the refund from the Internal Revenue Service. It is generally thought that, general thought is that overpaying the IRS is a bad idea. If you're getting a big tax refund, that is an indication that you are overpaying the IRS, and you can make adjustments on your W-4. So next, 5 examples of income that must be included and reported to the Internal Revenue Service. That's Concept Check 4.2. wages and salaries, commissions, bonuses, tips earned, which we all know that nobody reports cash tips, but supposed to, but that interest and investment income, retirement income. So long-term capital gains and short-term capital gains, how are they treated differently? The long-term capital gains are taxed at lower capital gains rate, while short-term capital gains are taxed as ordinary income using your marginal tax rate. And again, long-term capital gains can be taxed at 0%, 15%, and 20%. 5 examples of the income that is excluded from IRS reporting. So gifts, inherited money or property, life insurance benefits. Remember that those has to be paid for on an after-tax basis. Child support payments, scholarships spent on required fees. 3 examples of adjustments to income. IRA contribution, alimony paid with new limitations under the new tax law. The student loan interest paid. Tax credit, examples of tax credit, I believe I listed them all here. Health insurance premium tax credit, American Opportunity Tax Credit, Lifetime Learning Tax Credit, Child Independent Care Tax Credit, Child Tax Credit, Mortgage Interest Credit, Retirement Savings Contribution Credit, Elderly and Disabled Tax Credit. The next learning objective, you use appropriate strategies to avoid overpaying income taxes. We will start the next lecture there.